Mr. Rosensteel, Ms. Higa, Ms. Yamamoto, Ms. Dillon, Ms. Hendricks, Ms. Vargas, for the Superintendent of Public Instruction, Ms. Zumat, and for the Director of Finance, Ms. Wong Hernandez. Chairperson Keeley, you have a quorum.
Thank you, Jennifer. Item 1 on the agenda is the approval of the committee agenda. I would ask that we adopt the agenda for today with some flexibility so that we can move a few items around to accommodate a 10:15 start. So if that's okay.
Move approval with flexibility.
Thank you.
Second.
It's moved and properly seconded. Any objection to that? Seeing none, we'll adopt the agenda with some flexibility. Thank you. Item 2 is the consent agenda action item. There are, it's two, why don't we look at consent agenda 2, 3, and 4. Does anyone want to pull any of the items from consent 2, 3, and 4? Okay, thank you. Jennifer, consent doesn't need a vote, right? Thank you. Consent item 5, which is the committee work plan, fiscal year 2018-19. I know Ms. Yamamoto had a question because it was listed as consent agenda and information. Did you?
Item 6.
Yeah, consent number 5. Yep. It's listed as information. Did you have a question on that, Karen?
No.
Okay.
Item 6.
All right, item 6. Item 6 then is the staff report on additional opportunities for direct and co-investments. Karen?
I just wanted to remove that because I wanted some discussion on that.
All right, so we'll pull that, item 6. Item 5, any objection to item 5? Seeing none, that's approved. And we'll go to item 6, which has been pulled. Karen Yamamoto.
You know what, Karen?
Yep.
So go ahead, and we'll change it.
Want to get to, can
Go
you?
ahead, Karen.
I don't have
Okay.
it.
So I just wanted to just kind of get some information out because
It's over there.
this is I guess I just completed my first year of being on the board. And so everything is kind of coming together. And so I didn't realize that this was part 3 of it. And so I just kind of wanted to discuss it because given that CalSTRS is considering a shift toward the internal and direct investing, I just kind of wanted to get some insight or get some information about what challenges that might be faced in doing that, what things we need to prepare for, what we as board members need to be alerted to. So just that kind of information is what I was looking for.
Great question, Karen. The goal for this year, when you guys set up this study of other alternative investment models, we always fumbled with the title, and I think originally we called it Direct and Co-Investment Opportunities. The first year that we're in right now was really just intended to be a study of what is it, what could happen. This is the conclusion for us, and we made it a consent item because the other items in the agenda were so full today. That based on the panel you had last month, our last meeting, and the insights, we all just coalesced around the idea of a collaborative model. Now, this next year, we're going to do exactly to work on those questions you just asked, which is the rest of this next fiscal year for the committee, we'll work on, okay, what does that collaborative model exactly mean for all the different asset classes? What are the challenges? What are the roadblocks? What are the opportunities? And what staff is going to be doing, we started after February, but what we'll be presenting a little bit, and you'll see it as a common theme throughout our July business plans. What does the collaborative model mean to each of the asset classes? So as you can see in the chart up there, we were noting already that private equity, infrastructure, real estate, we're already at different stages in this matrix of opportunities and in the collaborative model. And we'll come back to you, particularly in the fall and in the spring, then with specifics about here are the strengths, here are our weaknesses, here are things, either policies we might need to change, procedures we might need to change, or potentially even state law things that we might need done to be able to operate in this model. And each step along the way, you, the board, will have an opportunity to say, are we ready to go there? Do we really like that idea, or do we want to scale that back? So it really is the whole next year to be the discussion.
Thanks. I have one other light comment, Ms. Yamamoto, on this topic of direct investing, which we've highlighted before for the board. One thing the board should continue to think about as you hear these items, as you move from the left to the right-hand side of that chart, one of the advantages of internally managing more assets is you lower fees, you disintermediate the fees you're paying asset managers. But you also need to bear in mind you're also taking more responsibility for the diligence that has to occur to make prudent investment decisions. So there will be, as you move more towards the right, discussion on appropriate staffing levels to do the type of investing that you need to do without the help of asset managers, without the full help of asset managers, use of outside consultants and other resources to make those types of investment judgments. So I think in any fund that deals with direct investing, that trade-off is always part of the dialogue.
Anything else, Karen?
Thank you.
Betty?
Thanks, Harry. While we're on this, I just wanted to maybe pose a couple questions for consideration when this comes back, and that is, obviously, as we move in these directions, to identify any regulatory or legal barriers that might prevent us from implementation, I think would be helpful. And then, and maybe just a sense of whether there are other investors that are kind of going down this road, so we kind of get a feel that we're going to have collaboration, right? So, and I wasn't sure if this is a premature question as you continue to look at ferreting this out, but whether you're going to be looking at a specific asset class to kind of use as a test case, or are we looking at kind of just broadly across the portfolio relative to moving in these directions?
I'll jump in and answer those, Betty. The first is, are other investors looking at this? Absolutely. In fact, we've had collaborative discussions starting last year, actually this week, and certainly into the summer. The private equity, the private markets team, so Paul, Margot, and Mike, and some of my staff made trips north of here, is all I'll say, to meet with other funds. Just last week at the Milken Conference, I had 3 side meetings with other CIOs from other large global funds to talk about this exact issue. And I think some of the US funds, maybe even our buddies across the river, are talking about this. We're probably the first fund to use the word collaborative that Ashby used and sort of embrace that. So I think we're getting a lot of headlines, is that we're farther along, but I think everybody is trying to explore this of how do you move beyond partnership investments and what does that mean? Obviously, other funds in other jurisdictions have different business models and have allowed them to move farther down the scale. I'm sorry, your follow-up question was?
The regulatory legal barriers.
Oh, regulatory legal barriers.
The analysis, I'm sure.
Yeah, no, we'll come back with you every step of the way on that. As we've already started to brainstorm on this, some are pretty obvious because we're a state agency versus some of the different models that other people have used, say all the way out to the investment management company that the endowments use. So we'll come back to you every step of the way with, here are the pros and cons with each of these models. What's realistic in our environment versus what's too difficult to accomplish, or it comes at too high a cost. And your question about whether it's going to be we'll start with a specific asset class. One of the requests from a board member was to not, even though you've got a triumphant group of 3 up here in front of you, to not come at you as a big bundle, but to actually separate this. And that's our plan. You will see the collaborative model actually addressed in every single business plan, even the public markets, because there's opportunities for June and for Glenn and corporate governance. What does it mean to them? But in the future, in this item, we will try to break it out by asset class. So here's what are the impediments to real estate versus private equity versus inflation sensitive or the other asset classes.
That's great. Good. Thank you.
Thanks, Chris. I think it was Joy who made that suggestion on our call last week with the staff, was to break it out by asset class, which really makes a lot of sense.
Yeah.
And perhaps Chris will update us a little bit more into detail in closed session on those private conversations, which are strategic, that would be appropriate for closed session for us to have a little bit more insight into the types of conversations and maybe the individuals that Chris has been speaking to help us think about this initiative going forward. Paul?
Thank you. So I'm happy to see this, and I think what we heard at the last meeting from Ashby and the others was a great model, and I'm glad that we're trying to embrace that where it makes sense. So, as I took away from that conversation, there were sort of two elements, which is that we, rather than deciding that we're just going to be our own real estate shop and not work with real estate investors who we've worked with in the past, who are expert, we're going to collaborate with them. We're going to make them part of the process. And I think that makes a whole lot of sense. The two other things I took away from it was that in doing so, though, collaboration means, first of all, addressing Betty's question of, are there others out there who we can work with? So I think whatever we get back should reflect what you've already described, Chris, as attempts to do that. I think the other thing is that while it does involve collaboration with the private market participants, at least Ashby and the way he described it and his book is very clear about trying to redefine that relationship. So I'm hoping we'll also hear back about how we're going to try to redefine that relationship to get maximum advantage from their expertise, but to our advantage. So I look forward to this. I think it's a great step forward, and thank you for all the work that's been done on it so far.
Thanks, Paul. I think you hit the nail on the head. How do we use the competitive advantages that we have had historically? Who are the types of partners we want, whether we want to partner with going forward, so that we get a purer alignment in the years ahead. And it's really the committee that said we want to make this a 2-year work plan. So this seems to be the next logical step. I'm enthusiastic about it. I think Chris, as he updates us more about the conversations he's been having and what some of those possibilities are. But it will all come down to essentially execution, right? Execution. And as someone said, the most important decision you can make is who you decide to partner with. And we have to trust our staff that they'll be able to choose wisely. Anyone else on this item, which is item 6? Okay, seeing no one, we went through consent 2, 3, and 4 really quickly, and my mic wasn't coordinated here, so Sharon was trying to get my attention, and she got it. So, so I want to go to Betty. I'm going to just skip through here, and if that's okay. Sharon has a statement on item 4, which was the investment belief statement. Sharon?
Yeah, I just wanted to, I love consent because we can breeze through a few things, but I guess it caught my attention that I was looking at the dates when we started the conversation on investment beliefs, and it was October of 2015, and it is May 2018, as I understand it, right? So that's, I don't know, you do the math, 2.5 years or so. So it took a while. And so I think I just want to acknowledge how, to me, the process that we went through as a board, our board actually, we had different folks participate. I think we had some board turnover at the time too. So I wanted to acknowledge Tom Unterman and other board members that aren't here that have influenced this list of 8 beliefs. And I really appreciated the discussion we had on beliefs 7 and 8, and from input from stakeholders as well, that I look at this list now and kind of, I feel like, it captures, I think, where we're at right now in terms of our investment team and our beliefs. And it feels important to just kind of, we can move on now. We have them established and we're done with the process for now. And obviously we can make modifications in the future. But to me, it's more about the process than even the product of this exercise. To me, I think that the conversations that each of us have had with each other online and offline about some of these really challenging issues I think has made us a stronger board and has helped clarify our vision for where we want to move. And so I just wanted to say thank you to staff. I know it's been a process for the staff and for our stakeholders in the room. Thank you for your input and for the board. I think I'm proud of these statements, and I'm hoping maybe we can figure out a way to, I don't know, encapsulate them on something like a card or something so we can have them with us as we talk to folks around the world. So thank you.
You bet. I just want to add to the board, they will appear in your board book now as the beginning of section 1000. And then the investment policy will be 1000A. So we'll just insert it right in there. And then we'll come back to you in July with the investment policy management plan referencing this. Instead of embedding this document, it goes first, the beliefs goes first, then the investment policy, then all the other policies. So it'll flow nicely.
Okay. Anyone else have a comment or statement? Betty, if you could just push the button again, sure.
Great, thank you. Agree with Sharon on this, and I think this is really a great body of work and the time that we spent on it. I think just being a teacher's retirement fund is rubbing off on me, but the belief statements themselves under the belief number, some of them are incomplete sentences. So I'm just- Sorry. And I could read number one as either a phrase or a complete sentence, depending on how you use benefits. And then number three, I think, also looked like it was incomplete, but just kind of round that out. I think they're easy fixes, so.
Noted? Okay, very good. Thank you. Thank you, Betty. Which brings us to we're going to skip right to item 10. As a reminder, we have a time certain item at 10:15, so we're going to skip and go to our Chief Investment Officer's report. Chris, item 10.
There we go. Thank you. Good morning, everybody. I apologize for the Band-Aid. It didn't cut myself. I told the board I had a biopsy and didn't realize with it being board week, don't do stuff like that. But anyway, so the assets of the fund back in March were 225 billion, 222, pardon me. We were off a little bit of the high. We're right now around 225. Obviously, the markets continue to go very much sideways. But the first quarter of 2018 was almost flat from December, but clearly, when you look at everything, that early January run-up is going to reference the high for the year so far. Here's the asset allocation, and I guess the highlight I would say for the teachers in the back of the room, we are right on top of our allocation targets, our interim targets that we wanted to be at. So we are not taking much of a tilt one way or the other in the portfolio. Within many of the asset classes, we're leaning defensively. So I would say there's sort of a neutral asset allocation with a defensive tilt. The cash position ebbs and flows because of the fluctuation. Whenever I take a picture of the portfolio right at the end of a month, that's right when the benefit payments are going out. So the cash suddenly drops. And reality is our cash position is running constantly around 2 to 2.5. Even though that showed a lower number. So here's back to June 30, because that's our fiscal year. Here's the Russell 3000 fiscal year to date. And you can see that run up that we saw in the fall, very nice, strong market. But I am concerned about the pattern that we've created in the last, say, 4 months. This is getting kind of wonky with the technical charts. So technical analysis is where you draw the lines on the charts. Rising bottoms, declining tops, things like that. But the red line really shows you that we've had lower highs. So lower highs means the market's narrowing. The bottom is actually kind of held in there. And this is technically called a flag and pennant. So if you think about those two lines converging, and that's a significant break point, the technical analysis people would tell you that just look at charts. That pennant point makes me nervous because, frankly, it's the very end of May, early June. I much wish it was going to be the July 1st, so we'd be past the finish line for this year. Not that I'm looking short term, but just like to get this return, this good year booked. You always have to overlay this with fundamentals. And sadly, now you have to overlay this with presidential tweets. So as much as we can chart the market and think that gives us an indication, fundamentals will trump that in a heartbeat. GDP, employment numbers, inflation numbers, things like that. So we'll just have to continue to watch how this market trades. But for all the volatility you've seen so far in 2018, it's important to know it's actually stayed inside this channel. And it has been volatile. What I've tried to point out to people is 2017 was the abnormal year where there was no volatility. The market just tended to roll up all the time. I told you last meeting to watch the yield curve. I want to bring it back to you because you're going to hear a lot of talk about the fact that the 10-year U.S. Treasury is crossing 3%. You can see in this chart in the green line, that's the more recent period. It is right at 3%. Rates have moved higher. Let me go back there. Rates have moved higher. So the blue line is last June 30. The green line is about 2 weeks ago. Notice that it's also flattened. The slope of that line has flattened. And that's what, when people talk about the inverse yield curve, it would be the short end going higher than the long end, and the curve, instead of being positively sloped, the risk of the curve being negatively sloped. So here's to dive into bonds a little bit. This is the spread between that 10-year and that 30-year. So look at the far end of the graph on the right side, 10-year note and the 30-year bond, and we're measuring the spread, the gap between those two. It started the year at a full percent or in 14, but now it has gone all the way down to just what we say is 20 basis points. I put in red there, that's if that part of the curve went negative. It doesn't automatically mean we'll have a recession, but historically it has foretold a recession is likely coming, which is why you'll hear that periodically on the news and on people's minds. I think, frankly, the bond market's a better gauge for us of the economy than the stock market right now. If you ask Glenn, that's always true. Ask June, it's not, but that's part of the fun of equity and debt. But we're going to be kind of geeky wonks and be watching the 10 to 30 spread very closely to see is that narrowing down to almost zero and even tighter. Very busy slide, I realize that, but the point of it was to tell you that trade matters. We got this from Eurasia Group, which is one of our consultants that does international. So what you can see on this chart is the USA on one side, China on the other, and then the surrounding countries and the interdependence. Look at the size of those arrows going in and out, that basically trade is global. The U.S. trade, number one, obviously comes in with our export market going out is really NAFTA, Canada and Mexico, but China does matter for us to sell into. Imports, what do we get coming back in? China's number one by far, but then again, NAFTA, Mexico and Canada. So as much as we see these tweets, the markets react because trade matters. It is a global world. You can see the inner dynamics even for China with Korea and Japan and India and Germany being trade partners with just about everybody. So it matters, and it is something to keep watching. It is not a small subject that we just don't concern ourselves about. It is something we focus on very much. And a trade war, as you've heard people say, that has very severe consequences for the global economy. Obviously, we're now at sort of skirmishes or threats and fights. But we are very much closer to, some kind of a war. This on and off about whether their treaties are being honored and followed or not. And as we've heard, a lot of this is similar to the kind of negotiations I've always seen in real estate, which is very bold statements at the beginning, and then you get down to the table and the nitty gritty. Picture yourself when you're even buying a home, and this is taking it to an extreme, but you throw out a number and that person either accepts that number or not. It's kind of a bold statement. Then you get down to the escrow and all these, think of all the paperwork and all the details. So that's almost what we're going through here is these bold negotiating statements because the president comes from that background. bold negotiating statements, but really what matters is all the nuance and the details. But we're so used to responding to the headline, it's been a real challenge. So if I climb up the crow's nest, the things to monitor, I'm going to keep North Korea up there. Obviously, we've had very good signs lately. But I think if you listen to the people that are experts in global diplomacy, they will tell you that North Korea has done this before and not to be trusted. I'm going to keep presidential tweets up there because they seem to rile the market every time they come out, and that's just so unpredictable. One individual and an electronic global system. The other one I'm going to highlight on there, you heard it at the offsite, was the internet disruption. I have heard that now 3 times, in addition, 2 more times in addition to the offsite. The belief that a utility or a financial institution may suffer a service attack. They've made it, what I have heard is it's not necessarily even in the USA. One central bank, I think, I'm going to say Bangladesh. There's a central bank that's been hacked, but nothing major. And so it's a risk. It will happen. It will surprise us. So it falls in that category of inevitable risks. And then lastly, one that pops up every once in a while and gets repeated is pandemic with the global economy. On the positive side, sorry to say it's a very short list as always, but it's a good list, which is, slow and steady. It's Goldilocks. It's not too hot. It's not too cold. But that story doesn't end super well, as I recall. I haven't read it in a long time, actually, I have to admit. So it feels very uncomfortable to me personally. I am just not comfortable going along and slow and steady, but we're slow and steady and we're doing all right. The central banks continue to unwind and Brexit's coming along. That's kind of the end of my presentation. I just want to highlight for the teachers in the back of the room who write newsletters for us. You can always get up-to-date information on the .com website. The tabs at the top, just click on investments, and then there you can see all kinds of up-to-date information, including videos. So please don't hesitate to use that for your articles. Open, and then let's see, thank you for coming forward, because I did forget. Corporate governance. We have a couple of updates on our engagement we want to share with you. So I will turn it over to Brian and Aisha, our co-interim acting directors of corporate governance for Ann, and they have the engagement sheet on INV 82.
Good morning. I'm Aisha Mastagni. We just wanted to update a couple things that are because the value of engagement is part of Chris's CIO report, and just a couple things we wanted to highlight. First, an update related to our opioid engagements. As some of you know, we're part of the Investors for Opioid Accountability. It's a group of investors that are engaging distributors and manufacturers that are involved in opioids. And we had kind of a watershed moment yesterday because one of the companies that we've been engaging with, Depot Med, there was a member of the opioid group that had submitted a proposal asking the company to produce a report on what they were doing to monitor the financial and headline risks associated with opioids. And that proposal actually passed yesterday. It was announced at the meeting. So that is a big moment. So we'll update this for next quarter, and you'll see that on there. The other thing that I just wanted to bring to everyone's attention was related to our engagement with K-12. Some of you know we've been engaging with K-12 for about the last 2 years. They had some serious governance concerns of ours. They had serious compensation issues. They had a co-CEO situation. And then there was also K-12's involvement with CAVA, the California Virtual Academy, and their negotiations with CTA. So I'm just proud to report that we met with K-12 back in March, and since then they updated us on the number of governance changes they've made. They've revamped the compensation plan to be more in line with shareholders, and I'm happy to report that CAVA and CTA came to a resolution in mid-April. So just wanted to bring you up to date.
Good morning. I wanted to update, certainly. Okay, I wanted to update you on climate change risk management efforts, particularly around the Climate Action 100 Plus. I know we've been a bit vague around what's going on with that effort, but it's, I guess to say it's gone live. And to remind you, this is a global collaboration around climate change risk management. There's about 279 investors, about 30 trillion in assets under management. The asks of companies, and this is focused on the largest carbon emitters globally, the asks being a strong governance framework, board accountability and oversight around climate change risk, commitment to reduce greenhouse gas emissions, and then improved disclosure around climate change risk management, particularly as it aligns to the TCFD, or Task Force on Climate Change related financial disclosure. So CalSTRS will be the lead at 3 of the companies. Southern Company, which is a gas and electric company that primarily operates in the Southeast United States. Duke Energy, which is an electric power generation company with most of its operations in the Midwest and the South. And then Phillips 66, which is a refining and midstream distribution of oil and gas. We've had preliminary talks with each of these companies. I would say they're not necessarily enthusiastic, but certainly willing to work with us. We'll expect to schedule more concrete meetings, calls with our partners on these particular engagements, and then keep you updated at future meetings.
And then just last but not least, I think you all have a copy of, so that was just some highlights, but we wanted to pass out, and I think you have a copy of the Corporate Governance Annual Report. So that is just compiles all the work we've done over the past year, and it's very comprehensive. So if you have any questions about that, we're happy to address.
I definitely want to acknowledge the CG staff for the hard work that they did in putting this together, and our communications team here at CalSTRS for their help in publishing it.
And it's on the website too.
Yeah, this is terrific. Investing and engaging for the long term. I would just ask that perhaps someone from the team can check with the key stakeholders that attend our meetings regularly and see that they have a hard copy if they'd like.
We did put some in the back in case anyone's interested.
Perfect. Betty?
Thanks, Harry. I just had a question with regard to the Tesla vote against the executive compensation and due to the size and the potential dilution to shareholders. Was there? Can you just kind of provide a follow-up on that? And I was just curious with respect to how the factors were analyzed and what was the vote in the past with respect to Tesla?
So I know I don't have the exact numbers, but I know it did pass. CalSTRS voted against the pay package. We actually had a conversation with Tesla, including one of the board members, and to try to help us understand their thought process when they designed this.
Yeah.
At the end of the day, we just had serious concerns about how it was structured and the quantum, and quite frankly, the lack of focus on some profitability metrics, which I think is needed at Tesla, and in terms of how it was structured to keep him focused at that company.
Okay.
Unfortunately, it did pass.
Yeah. Okay. Thank you.
Sharon?
Thanks. This is great. I was lucky to go to Ceres last week, and it was my first time at Ceres, and I learned so much, and I think telling our story is something we've talked about quite a bit, and I feel like this, even just this little 2-pager that we can share with our stakeholders is really significant, because I'm proud of the work that we're doing, and I learned more about the Equator Principles last week, and more than I wanted to know about water and what's going on in our world. So I would highly recommend that conference to our board. I know Betty sits on the board and Jack is on the board. So, but it was really quite startling to learn all what's happening in our world and the impact that environmental change is having. So, but I guess more of this would be great. Just telling our story better, articulating it in clear and concise ways. I just think having precision about where we're engaging, how we're engaging, just helps, I think, our members understand the value of some of this when it comes under scrutiny, as it always does. Like, what is the value of engaging on ESG when we're supposed to be just focused on money, and we realize actually this is part of making money, is to be strategic about what's happening in the future. So this is great. I did have also a question about Tesla. Do we engage I know that there's been a lot in the news about the safety record and just, I think 3 times the injuries of workers at Tesla versus other auto manufacturers. And do we engage or?
We do engage with companies on basically what we call our human capital management, and I think the safety of the workers falls under that category. I actually have a follow-up because when we had the call with them prior to the vote on the compensation, we actually hadn't had a lot of contact with Tesla in the past, and I was happy to have that touch point now. So I want to go back to them and have further conversations about some of those issues that have been raised by some of our
I would like for us
stakeholders.
to do that because I think it's startling, some of the statistics on that particular issue.
Absolutely. This one was very focused. It was a special
Sure.
meeting just for the comp, but
Yeah.
now we have those contact points. That's good.
Good. Thanks, Aisha.
Thanks. Could you ring back in, Joy? For some reason, I double-clicked and I lost you. There we go. Joy.
Great, thank you. So Brian and Aisha, thanks very much for the report. I've got a question on the diversity efforts that we're making. And I know we're going to talk about this also a little bit later in the agenda, but it looks like we've continue, really strong focus on diversity. There's a sort of the opening paragraph talks about the engagement that we're doing with companies where we think there might be a lack of progress in diversity. And then a separate item regarding our work with the University of California Chief Investment Office. Is that the outreach we've done there on letters to California headquartered companies without women on the board, is that a subset of the numbers of companies that you have up at the top?
Well, we're attacking diversity on sort of, we have like multi-pronged approach with different groups that we're working with. I'd have to double check on, this was a partnership with the university. The first opening paragraph is related to specifically because we altered our principles to say that we could take further action in terms of voting against the nominating committees and perhaps the whole board when companies haven't taken action. And so those are companies where we've already had an engagement with them over a 1 or 2 year period, and we plan to vote against them. And then we'll come back after proxy season to give you an update about that. The University of California, these are specific to companies headquartered in California and are new engagements.
That's sort of like an additional effort.
Yes.
Okay, got it. Thank you.
Thanks. Brian, I just asked that you follow up with me sometime in the next few days. Really think it's important that we talk a little bit more in detail about the initiatives that you're leading with on climate risk and the engagement, the global collaboration that you and the team are actively involved with, and perhaps exerting some leadership in. There's 100 companies that you've identified over a 5-year period staff is going to be focused in on. That's no small feat. You glazed over the trillions of dollars under management that are represented, and that it's a global collaboration, and CalSTRS is leading it. I'd like to have more visibility into that, and I think the committee would as well. So why don't we talk offline about how we want to structure that on a going forward basis?
Happy to.
Yeah, sounds great. Thank you both very much. We will take a very, very brief break for 3 minutes, and we will start at 10:15.